It's time for the MF Corner. A well-placed contrarian bet can make a huge difference to your portfolio. But is it wise to bet on a contrarian fund? That's the big question we're asking on the MF Corner today. And our expert, Dhirendra Kumar, CEO of Value Research, joins us live and exclusive as always, right here on the show. Afternoon, Dhirendra. Despite of a full cycle in the market over in the last year or so, contra funds haven't really done too well. They haven't outshone the Sensex by a huge margin. Why did this strategy not work?
It is tough to, manage a contra fund because most of the contra funds, they are unable to stick to, they are unable to, they don't reflect a conviction. They don't reflect a strong conviction. And I think, most contra funds, they started at some point as a nice marketing play. But open-end funds, they are expected to perform well in all kind of market. And contra fund, or to follow this strategy with conviction, I think it will require to be sticking to a kind of portfolio which will not do well on many occasions, and it will do very well on at some point. And for such holding period, such longer holding period, I think an open-end structure is not very conducive. So that is perhaps the reason why these contra funds have not taken off in any significant way so far.
The best fund of the category for the one-year period is Kotak Contra Fund. What is responsible for the sudden spurt in the performance that we've seen?
Kotak Contra has struggled, but this time round, it has benefited by losing less. This Kotak Contra does not translate into a pleasant experience for investors because all that it has done is it has lost less. And the way it has gone about doing it is getting overweight into FMCG and pharma ahead of other funds, and quite significantly so, with 18% exposure.
Okay, they were overweight on FMCG, and so they did relatively better than some of the other funds. Dhirendra, let's also take in some viewer queries, because we've got plenty of viewers writing into us with queries. The first one is from Deepak Tripathi. He says he's got an MF account with a bank and he'd like to transfer all his equity mutual funds from 10 different fund houses to his wife. What is the process and what are the tax implications of this move?
There are two ways of going about it. One which will have some tax implication, other which will not have. If they are all equity fund and they have all been held for over 1 year, he can redeem those investments, get the money, invest it all over again in his wife's name, and there is no tax implication. If the investment is less than 1 year old, then it will have tax implication, because any gains which he has on the investment held for less than 1 year, short-term capital gains tax of 15% will be applicable. That apart, the same goal of being able to add his wife as the beneficiary, that can be had without actually transferring these investments in her name. The way to go about it is it is possible for an existing investment to have a co-owner, and he can get his wife's name added as a joint owner of all these investments which he has already made. This will have no tax implication whatsoever.
The second query today is from Kapil Sharma, and he says that he's taken Birla Sun Life ULIP plan 3 years back and he wants to switch to term insurance now, and he says, should he continue with the ULIP policy or should he redeem it?
He should consider getting out of ULIPs for 2-3 reasons. One is that you shouldn't be investing, you shouldn't be mixing investment and insurance. Older ULIPs, they were very expensive. It might make sense to take a call, but my general guideline for redeeming your older ULIP is that you must continue for the first 3 years, otherwise your money is forfeited. Generally in the older ULIPs, the surrender charges for redemption between third and fifth year used to be very high. So maybe you stop putting your premium, but don't pull out before fifth year. I think the third most important thing is take your policy document out from the locker and read it. Get the details, because there could be minor variance in all the older ULIPs. What I am telling you is the general structure of the older ULIPs, and after fifth year, by all means get out of them. You will save yourself and approach your investment and insurance separately.